if you're not familiar with NEOS, they have some of the best ETFs on the market. And in this video, we're going to be ranking all 12 of their ETFs. Some of them you're familiar with and some of them you may not have heard of. And we're going to be ranking them S tier, A tier, B tier, and C tier from best all the way down to worst. Now, I'm a huge fan of NEOS ETFs, and I know a lot of you are as well, and they're focused on option income strategies. Now, they're not like YieldMax where you're maximizing the distribution rates and having sky high yields, but they're also focused on NAV stability, which is something that's very key in this type of environment. So we can see they have ETFs for pretty much everything. They have equity, high income ETFs. They have hedged equity income, high income alternatives, and enhanced fixed income. And we can see the lineup. We have 12 different, they're all monthly paying ETFs, and they have pretty high distribution rates as we can see in the column. Now let's start off with these high income ETFs. They're going to be SPYI, QQQI, and IWMI. They're all going to be very similar in a strategy, but the difference is going to be their underlying index. So starting off with SPYI, it's going to be the S&P 500 high income ETF. And if you're not familiar with NEOS, it actually stands for Next Evolution Option Strategies ETFs. So they're focused on high quality ETFs, and we can definitely see the popularity with them. So for SPYI, it's going to be monthly distributions. All the expense ratios is going to be pretty similar at around 0.68%, which is kind of high, but we do have to note that these are all actively managed ETFs, so you do have to have some of that money going to the fund managers. But 0.68% is a respectable expense ratio, especially since we're getting some pretty nice returns. And we can see the distribution rate for SPYI is going to be 12.19%. On average, it's been between 10 to 12%. So 12% right now, we have a little bit more volatility in the market. We're going to see a higher distribution rate. And let's go over the targeted benefits of SPYI's strategy. So the strategy is going to seek high monthly income, which is going to be generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. So it's very complex language, but they're basically going to be buying the S&P 500, holding all the underlyings, and then selling call options on the S&P 500 index. And it's going to be actively managed, as you mentioned earlier, 0.68% expense ratio, but because it's going to be actively managed, we're going to have some better tax treatments. It's going to seek to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options, which is going to be classified as Section 1256 contracts, which is going to be subject to lower 60-40 tax rates. So you're going to be subject to 60% long-term capital gains and 40% short-term capital gains because of those Section 1256 contracts. And they're able to utilize this because when you sell options on an index like XPX or NDX for the NASDAQ, you can get some better tax treatment. Now, the third one is it's going to utilize a call option strategy that may include both sold and purchased SPX index options. So they're either going to be selling call options or doing some sort of call credit spreads, which is what I'm getting from this description. And the main thing with NEOS ETFs is it allows the potential for upside appreciation in rising markets. So a lot of the YieldMax ETFs are optimized for the highest yield possible. It's literally in the name YieldMax. But these NEOS ETFs, it's going to have room for upside potential in exchange for a lower distribution rate. As I mentioned earlier, SPYI only has a 12% distribution rate, which is pretty high, but not as high as the other ones from the other ETF issuers. And if we take a look at SPYI's chart, we can see that it does have downside risk, of course, because it is tracking the S&P 500, but it will always outperform the S&P 500 in down markets because you do have a little bit of that cushion with the dividends that you're receiving, which is generated from the option premiums. But we can see since April all the way until now, we have had a nice recovery all the way back to the $52 price point. So we do see that there is upside potential with this ETF. And that is something that is very important for long-term investors. And if we quickly take a look at the holdings, we can see it has over 500 holdings, 500 of those are, of course, going to beat the S&P 500, and it's going to be rebalanced monthly to align with the S&P 500 as well. Overall, I really like SPYI. It's one of the best ETFs out there for high income and stability, and for that reason, I'm going to be placing it at S tier. Now, I do want to note that this is just my personal opinion. Your opinions may differ, and I would love to hear in the comments below where you would rank some of these ETFs. Next, we have QQQI. And if we head over to the charts of QQQI, we can see very similar to the S&P 500 one, SPYI, but we do have a little bit more volatility with QQQI because it's on the NASDAQ 100, which is a little bit more volatile than the S&P 500. And if we take a look at NEOS's QQQI page, it actually won the ETF awards for Best New Active ETF of 2025. And if we take a look at the fund page, it has monthly distributions, the same exact expense ratio as mentioned earlier, and a higher distribution rate because it is a more volatile index at 14%. Now, this distribution rate kind of fluctuates between 12 and 14%. It can exceed 14 as well during volatile markets, but on average, it's about 12 to 14%. And if we take a look at the targeted benefits of QQQI strategy, it's the same exact as SPYI, except it's on the NASDAQ 100 index. Exact same strategy, the exact same tax treatment at 60% long-term capital gains and 40% short-term capital gains tax rates. The main thing for this ETF is if you want something that's going to generate a little more premium than SPYI and has room for capital appreciation. And for that reason, we're also going to be placing it in the S tier. Now, next we have IWMI, which is the same exact strategy, high income ETF, but it's going to be on the Russell 2000 index, which is pretty much going to be the small cap stocks, small to mid cap. It's going to have a higher distribution rate of 14.56%, which is more than the NASDAQ 100 index of QQQI. And of course, we're going to be having the same strategy, the same tax treatment. Now let's take a look at the chart for IWMI. We can see that it really hasn't been performing as well as SPYI and QQQI, and it's actually negative all time on the share price chart, and it hasn't recovered since Liberation Day. So if we take a look at the holdings, you are not going to have the individual holdings directly, but it's going to invest in the Vanguard Russell 2000 ETF, VTW. And if we take a look at VTWO, it really hasn't done too much. We do see some pretty nice capital appreciation here, but it really has underperformed the other indices of the S&P 500 as well as the NASDAQ 100. And even though it has a higher dividend yield, because it hasn't had that capital appreciation, it has severely lagged behind SPYI and QQQI. Now, if we take a look at the total returns between SPYI, QQQI, and IWMI, we can see year to date it is only 8%, which is lower than the SPYI and QQQI by a significant amount. And if we take a look at the total returns since inception, which was June 25 of 2024, we can see SPYI has a total return with dividends reinvested of 20%, QQQI has 23%, and IWMI is just under 16%. And this is the reason why SPYI and QQQI have been the favorites for the NEOS ETFs. QQQI is probably the #1 ETF from NEOS. For that reason, we're going to be placing it in A tier. It's a good fund, it has a solid total return, but it's not as good as SPYI or QQQI. Now next we have QQQH, which is going to be a similar strategy to QQQI. It's going to be the NASDAQ 100 Hedged Equity Income ETF. Now what's interesting with this ETF, it's been out since 2019, so it does have a longer history than some of these other ETFs. And of course, it's going to offer tax treatment, which is going to be very favorable for investors with taxable brokerages. And the difference between QQQH and QQQI is it's going to offer downside protection by buying out of the money puts. And that's going to eat into some of its yield, which is at 9.54%, so just under 10%, which is going to be about 5% lower yield than QQQI. So this is for people who are a little bit more conservative. They want that downside protection. We've seen that downside protection work, especially with ETFs like ULTY, and a lot of these newer ETFs are also coming out with their downside protection by buying some puts in exchange for some distribution rate. And if we take a look at the chart for QQQH, we can see we do still have that capital appreciation. So it's risen pretty nicely, but during downturns, you are going to lose some money, but not as much as QQQI. And if we actually compare the returns of QQQI and QQQH, we can see that SPYI has obviously outperformed because it's not losing that distributions to buying puts, but you're only down about 2 to 3% compared to QQQH. And if we take a look at the charts, we do see that QQQH is going to be a little less volatile. So for people who don't want to be as risky, QQQH could be a good investment for you. But overall, QQQI is going to outperform, and for that reason, we're going to be placing that in A tier. It's a good fund, it's a little bit more conservative, but I do think QQQI outperforms. Now next we have SPYH, which is similar to QQQH, but it's going to be on the S&P 500. It's going to have a distribution rate of just under 8%, so it is quite low, and it's going to have the same strategy. It's going to sell call options to generate income, but also have that measure of downside protection by buying put options. And if we take a look at the chart, this ETF has only been out since April 3rd. It's had some pretty good capital appreciation, mainly because it came out April 3rd, which was right after Liberation Day, so it's been nothing but up. It's up 12% since April, which is a very good return. And it's very good to see that NEOS is leaving that upside potential for capital gains, in addition to some pretty juicy income. But in my opinion, SPYI would be the better choice. SPYI is already less volatile than QQQI, and I think if you want to buy QQQI, want less volatility, SPYI or QQQH is a better option than SPYH. And for that reason, we're going to be placing it in B tier. It's an average ETF. You're not going to outperform any markets. It has a pretty low yield, and it's just okay in my opinion. Now next we have BTCI. BTCI is going to be a very popular ETF for NEOS, and that is because BTCI has one of the highest distribution rates. Right now it's at about 28%, which is double QQQI. But the downside is it's going to have a high expense ratio at 0.98%. Now compared to some other Bitcoin high income ETFs, that is pretty much on par what expense ratio you can expect. And if we take a look at the benefits of BTCI, distribute monthly income generated by writing call options on Bitcoin future ETFs, actively manage, and is going to seek to offer upside potential via efficient exposure to those Bitcoin ETPs. And it's going to implement a data-driven call option strategy, saving investors the time and potential expenses of trading options themselves. And that is the main reason why we invest in these income option ETFs. We don't want to spend all that time in trading these options ourselves. A lot of us have day jobs, a lot of us are busy, and it's better to just pay a small expense ratio in exchange for the experts doing it themselves. And if we take a look at BTCI, it is up 22% since inception, which was released October 17, 2024. So it has amazing capital appreciation, very high distribution rate, and overall a great ETF, especially if you want some Bitcoin or crypto exposure. And for that reason, we're going to be placing BTCI into S tier. Now next we have IYRI. Little hard to pronounce, but it's going to be one that's not really talked about from NEOS, and it's going to be the real estate high income ETF. Now if you take a look at the distribution rate, it's going to be just around 11%. Of course, these distributions are subject to change, but for now it's been between 10 and 11%, which is a pretty high distribution rate, especially for a real estate or REIT. Now let's take a look at the targeted benefits of the strategy. It's going to seek to distribute high levels of monthly income through call option strategy on ETFs that seek to track the Dow Jones US Real Estate Capped Index. And it's going to offer upside potential. As with almost all of their ETFs, you're going to have upside potential in addition to high monthly income. And you're also going to offer efficient exposure to a portfolio of US listed REITs with an enhanced layer of monthly income potential packed into a single ETF. So it sounds like it's pretty diverse, and it sounds like it's going to be paying out some pretty good distributions for a real estate ETF. If we take a look at the chart for IYRI, we can see it's pretty much flat. So you're going to get that 11% distribution rate, but you're not going to see too much in terms of share price appreciation or even depreciation. And that is pretty normal for some real estate ETFs, which don't move too much. And if we take a look at the holdings for IYRI, we can see we have stuff like Realty Income Corporation, Public Storage, we have Extra Space Storage, Essex Property Trust. So a lot of real estate companies, a lot of real estate ETFs in this portfolio, pretty diversified. In my opinion, if I were to buy a real estate ETF, IYRI would definitely be on my radar and probably one of my top picks. Right now, IYRI and other real estate ETFs don't really offer that yield that I'm looking for, but for that reason, we're going to be placing it into A tier. It's a great real estate ETF for high income, but SPYI, QQQI, BTCI are going to have higher total returns, especially in the long term. Now, next we have gold, which is going to be IAUI. Kind of a weird name, but it has the AU, which is going to be the chemical symbol for gold. And what's interesting for this ETF, it's going to have a pretty high distribution rate of 12.56%, which is pretty much on par with SPYI's distribution rate. But we can't go off of the distribution rate alone, as we saw earlier. IWMI had a higher distribution rate than QQI and SPYI alone, but you also want that capital appreciation. So what is this ETF? It's going to sell call options on gold ETPs and offer appreciation based on exposure to physical gold. A lot of people who are looking for a gold ETF, this ETF could definitely be on your radar, offering monthly distributions and capital appreciation. Now, if we take a look at the chart, it's up 3.15% all time. And it's only been out for a few months now. It's been out since June 5th, 2025. And if you're familiar with gold, it doesn't really move too much. It's pretty stable. So you're not going to see too much in terms of capital appreciation, but in my opinion, you're not really going to see too much downside risk either, especially since the option premiums are going to offset any drawdowns. Now, just like IYRI, it's going to have some pretty decent monthly distributions, but you're not going to have that big capital appreciation as these top three. And for that reason, we're going to be placing it in A tier as well. Now, next we have some interesting ones. Next up is going to be HYBI. Now, HYBI is the NEOS Enhanced Option, Enhanced Income Credit Select ETF. Distribution rate pretty low at 8.47%. Let's see what this ETF exactly is. So it's going to allocate some assets between high yield securities and investment grade securities and overlay a data-driven put option strategy. So it's going to have some bond ETFs, maybe some treasuries, and it's going to sell put options on the PX, which is going to be the S&P 500. And those distributions are going to be classified as Section 1256 contracts. So you can get that favorable tax treatment if you're holding in a normal brokerage. And if you take a look at the chart, it's down about 3% all time. It came out September 30th, 2024. Let's take a look at the holdings. You're going to see a lot of, so we have a little bit of treasuries. We have mostly high yield bonds. We have the SPYI portfolio high yield bond ETF. We have this high yield corporate bond ETF and another broad USD high yield corporate bond ETF as well. And then, of course, we have our put options that the ETF is selling on the S&P 500 index to generate some more premiums. And that's where the name really comes from. The hybrid is going to be pretty much bonds and a little bit of put option selling to create a hybrid ETF. This is a very conservative ETF. It's not going to give me personally the returns that I need. I'm going to be placing it in B tier. But for people who are a little bit more conservative, they like the strategy, it could be a very interesting choice to have in your portfolio. Now next we have BNDI, which is going to be a bond ETF by NEOS. And that's kind of what we really like with NEOS, we have a bunch of ETFs all for different purposes. So this is going to be definitely a conservative ETF. We can see the distribution rate is going to be just under 6%. But for a bond ETF, it's going to be much higher than, say, BND, which is at about 4%. So the strategy for BND is it's going to invest in the US aggregate bond market and implement a data-driven put option strategy similar to HYBI, selling options on the S&P 500 index. So it's pretty much going to be another hybrid ETF. This one's going to be a little bit more conservative. It is down 4% since inception of August 2022. But if we take a look at the holdings, it's pretty much going to be holding BND, which is the Vanguard Total Bond Market ETF, and AGG, which is the iShares Core US Aggregate Bond ETF. And then, of course, we have our put options we're selling on the S&P 500. So if you're looking for purely income, something that doesn't really move too much, and you have a huge portfolio, not wanting to take on a lot of volatility or risk, BNDI would be your best bet. Mostly for retirees or people looking to retire and can't stomach volatility and want to be a little bit conservative with their withdrawals. For me personally, I think that it's not really meant for my portfolio at my age. I'm going to be placing it as C tier as it does have one of the lowest total returns. Now next we have CSHI, and we actually made a video a few days ago about CSHI, and it's pretty much a place to park your cash. It's going to be the enhanced income 1 to 3 month T-bill ETF, distribution rate at 5.12%. So it is lower than BNDI, but I am a pretty big fan of this ETF to park your cash, mainly because it is pretty safe. If you take a look at the chart for CSHI, you're pretty much not going to lose money. It's pretty much going to hover around the $50 price range. So it's a good place to park your cash. Of course, I like SGov for parking cash. You're not going to have as much volatility, but CSHI is going to give you 1% more distributions per year if that's what you're into. But for that reason, we're going to be placing CSHI into a B tier. It's a pretty good place to park an emergency fund. Now next we have TLTI, the NEOS Enhanced Income 20 plus year Treasury Bond ETF. Distribution rate going to be 6.47%. It's going to sell put options, I think, on TLT as well as holding TLT. And if you're not familiar with TLT, TLT is going to be what it's based off of. It's the iShares 20 plus year Treasury Bond ETF. I recently bought some of TLT, replacing my Realty Income, because I do think that interest rates are going to fall. And if interest rates fall, TLT is going to rise in share price. And I bought this ETF, about 100 shares of it at the $86 price point, and it's been doing pretty nicely. And it does pay out 4.30% distributions paid out monthly. Now for TLTI, it's going to add an options overlay strategy to juice up that premium. As we mentioned earlier, it's going to have a 6.47% distribution rate, which is 2% higher than TLT. But if we take a look at the chart all the time, it's going to be negative 4.81%. So that is something to keep in mind. And if we actually compare TLT to TLTI, we can see TLT outperforms. It's going to be 6% year to date versus 5.60% for TLTI year to date. Take a look at the total returns since December of 2024. It's going to be pretty close in total returns. TLT is going to come up on top. I do think that TLT itself is pretty stable where it's at, and investing in TLTI is going to lower your returns. And for that reason, I'm going to be placing TLTI in the C tier. So there you have it, all 12 NEOS ETFs ranked. I do think that NEOS has some pretty quality ETFs, especially a pretty diversified lineup. Even though it's only 12 ETFs, they are coming out with some boosted ETFs, which I'm very excited for. We also have a video covering that as well, but it's basically going to be based off of SPYI, QQQI, and BTCI. It's going to use 1.5 times leverage in order to juice up the income returns. So let me know down in the comments how you would rank these ETFs. Do you agree with any of these choosings or disagree? Let me know. This is just my personal opinion, and your personal preference can differ as well.